So good afternoon and welcome. My name is Marina Zuganova, and on behalf of EMEA Executive Committee, I am very happy to welcome all of you on our today's webinar. As you know, several years ago, EMEA has started permanent working group on engineering insurance statistics, which is presented every year on our annual conference. These statistics give our members the full picture of situation and trends on global engineering insurance market. And this is one part of engineering underwriters' day-to-day work. The other one is portfolio management, and this is the main topic of our today's webinar. The topic will be presented by David Turner. A few words about David. David has been the construction engineering portfolio manager at Rockstone Underwriting, headquartered in London. David has been working in engineering market since 1978, combining experience in broking and underwriting. Prior to Rockstone, David was global construction practice leader at Talbot Underwriting and CEO of Willis Construction Risks. Before handing over to David, I would like to draw your attention to small housekeeping rules. Our presentation will be about 40-45 minutes, and usually we have a Q&A session afterwards. But to encourage more lively discussion, we are proposing you to ask your questions during the presentation on the chat. And after the presentation, we will read and answer this question. If your question doesn't get answered, we will email you in due course. The recording of the webinar and presentation will be added to EMEA website within a couple of days. And also, we can offer attendance certificate, which would be useful for CPD and IDD purposes. And in case if you need this certificate, please contact Stephanie or myself. With this, I'm finishing with a small introduction and handing over to David.
Thank you very much indeed. Good afternoon or good morning, depending upon where on the planet you're dialing in from.
Excuse me, David, you can show your camera, that's fine, so people can see you.
Here we go. Is that working?
Yes.
Yep, all good. Okay, thank you very much, Stephanie. Yes, we've got about 45 minutes and then we'll hopefully have some time for Q&A at the end. I think that the definition of a successful webinar is that probably the same number of people are online at the end as there are at the beginning. So hang in there because it's a great ending. What we're going to try to do is to attempt to take a global view of the market dynamics in construction and engineering. I hope this doesn't come across as being too London-centric. This is very much slanted towards the underwriting community and perhaps more inclined towards the subscription markets rather than 100%, but I'm trying to bring some balance into that. I think that we work in a fairly volatile market environment, and we'll be talking about that more later. So those of you that want a quiet life and want more predictability, I recommend that you stick to life insurance. For those of you who only joined the market since July of 2018, and you're thinking, what is a market cycle? You've only experienced a hard market, then stick with us because we are going to delve back a little further than that and look at some of the features of hard and soft markets. When we talk about why, we're really talking about not why the market is subject to cycles, but why it is important to recognize these and why it's important that these are carefully managed. Because unlike the stock market, you can't watch a bank of screens and see the market move. And therefore you can't decide when to sell and when to buy. It is not as instantaneous as that. And this is therefore more about sensing the market and using judgment to feel and read the dynamics of the market rather than the Financial Times. No one is immune to the market cycles. Brokers need to be able to inform their clients about the dynamics of the market and what's going on. So the cyclical nature of our market cannot be ignored or underestimated. And the very nature of the construction and engineering markets is that they are very much more longer term business if you're writing a CAR and EAR portfolio. So property markets and other short-term markets, they are much easier to manage because obviously the cycles are somewhat more compressed, and also you see the results coming through a little quicker. Whereas if you're writing a portfolio that includes CAR and EAR, it takes a much more extensive period of time for those results to start to unravel. I think the important thing is to recognize that we're all inextricably linked to these market dynamics, whether you're in the subscription market or in the 100% market. We operate in a global interconnected market, and timing can be everything. And we'll look at that in more detail. So I think it's important to recognize the importance of being proactive, and recognize the impact that your strategy will have on trading through the market cycles, on the impact that it has on the management of your capital, on your underwriting performance, and the term I used here is the weight on the accelerator, because clearly in a soft market you need to have more weight on the brake perhaps than the accelerator, but in a hardening or improving market conditions you need to move the foot onto the accelerator and take advantage of those situations, and the impact that this has on your reserving strategy and indeed on your distribution. So the type of business that you're attracting and your the way that you're sourcing business will be impacted by what happens through the cycle. So timing is everything. I think there's an expression in many sports where people talk about playing with your heads up, and I think this is very much the case in this industry. I think we can have our heads down, obsessed with data, analytics, and all of that sort of stuff. That all is great and valuable tools, but I think there needs to be an awareness of what's going on around you so that you can look at your peer group, look at your competitors, seeing who's exiting, who's entering, look at the behavior of your competitors, whether it be aggressive behavior or signs of panic. Things move very quickly, and I think that those of you who were in the market in the second half of 2018 will have witnessed fairly monumental changes over a period of not even 6 months. So I think judging the timings is important. I think in my view, managing the down cycle is actually harder than managing the up cycle. The up cycle is like surfing. You found the wave and you ride the wave and until it delivers you to the beach and enjoy the ride. Managing the down cycle is, I think, more akin to the sailing analogy, where you're sailing into strong headwinds and strong tides, and therefore you need to be very smart on how you manage your way through those very difficult market conditions. So we're going to talk about the use of MI and the way that you can analyze pricing trends and loss triangulations. But when I say that too late is too late, I think that there are examples that we can look at where people have mistimed their moves in the market to their disadvantage and the disadvantage of their capital providers and shareholders. So how do we manage this process? I think that my experience, I think you have to trust your own judgment. I think, and not follow the herd, and keep reminding yourself of what your core objective is, which is to return a consistent underwriting profit across the cycles. So you may have a good year, but that's not good enough in terms of building up capital and building up a contingency fund to trade you through more difficult times. And that's a very tough objective to have. I think that we can look back and we can see situations where people and companies and organizations have, I would say, panicked. And I think that we need to make sure that actions are measured rather than panic. And I think that we can look back and we can see examples of people who've got their timings very badly wrong. So, for example, carriers that pulled out in the second half of 2018, who'd endured probably up to 8 to 10 years of weak, soft market conditions. And just as the market started to improve, they made the decision to exit. That is counterintuitive. The whole point of trading through the market conditions is that you have the resilience to trade through the soft and weak markets. And when the market conditions start to improve, then you can take advantage of that, rebuild your capital base and build up your contingency funds for when the market shifts again, and inevitably it will. So we need to look at what the drivers are that are going to impact these decisions and these strategies. So identifying the trends, particularly underperforming segments. So you will have a portfolio that may include plant and equipment, it may include machinery breakdown, it may include CAR, it may include EAR. And within those particular segments, there will be areas which have performed better than others. So, you know, at the moment, there is a great deal of nervousness around hydroelectric dams, for example. So, you know, we can isolate on those underperforming segments rather than just applying a broad brush approach across the entire portfolio. I think we have to learn to be bold, and turning around to our clients, whether they be brokers or insureds, and giving them hard news. Rates are going up, things are changing. I think that underwriters actually probably have more tools at their disposal than they really understand and realize. And again, we're going to talk a little bit about what those tools are and how those tools can be deployed in combination. So I think that people tend to get obsessed with rates. Rates go up, rates go down. It's not as simple and as linear and as black and white as that. So we need to look at all of those tools because they could often have more meaningful impacts on your portfolio performance than pure pricing factors. You need to plan for this. So in your planning with your capital providers, is the answer that you are a long-term player to this market, or are you more opportunistic? I think there is a danger if you are inclined to being more opportunistic, that you rotate out of a weakening market and then you accelerate into a hardening market. And that can cause some reputational impact. And also, I think it can cause some challenges in terms of getting market share back after you've pulled out, or indeed explaining to clients why it is that you're pulling out of a soft market. So I think the key to this is being able to trade through the market cycle, but adjusting to the market cycles and being smart about the way you approach that. So there's a very fine balance to be trod in terms of how you manage that portfolio. We will look in more detail at cycles, and I think it's important to understand that no one cycle is the same as another. Cycles vary in time, they vary in duration, and they vary in magnitudes. In other words, the wavelength of the cycle and the distance between the peaks and the troughs will vary according to market conditions. And these are impacted by large losses, they may be impacted by cat losses, or they may be impacted by attrition, or they may be impacted by a combination of all three. And I think it's very important to understand that market shifts are not unique to engineering. So we need to have almost like a 360 vision and look around and seeing what's happening in correlating markets. And by correlating markets, I refer particularly to property, maybe to energy, to treaty, and to the retro markets, where what's going on in those markets will probably eventually feed down into construction engineering. So what's going on is not happening in glorious isolation. One of the further challenge is the ability to look out in your planning more than 12 months. And in my experience, management have a great deal of joy in saying, what's your plan for the next 3 to 5 years? And anybody that can answer that with any degree of confidence deserves a medal. It is extremely challenging to look out into the medium and longer term, because there are so many things that are outside of your control. And we've only got to look at the events of the last 6 months to see how volatile things are and see what the impact can be. We're now in a situation where we have supply chain shortages, we have rising interest rates, and this is something that we couldn't have foreseen only 9 months ago. I think it's also important to recognize that the future won't look like the past. So if we look back and we say, oh, this market or that market condition, you may have similarities and you may have features of those markets which reoccur, but in essence, what's happening in the present and what's happening in the future needs to be managed in the present, because we can't go back and look at and remain obsessed about the past. I think it's very important to always go back to your basics, your basic goals and objectives of underwriting profit, your underwriting disciplines, the business that you're seeking, the business that you want to avoid, the way that you assess those risks, the way you price those risks, and not follow the herd. I think there has been a tendency in the past in soft market conditions to blame somebody else. You point the finger and say, oh, well, they were acting irresponsibly, or they didn't know what they were doing, and I think we have to turn around and go, we have to take control of our own destiny, and we have to take responsibility for our own actions and decision makings, rather than pointing the finger elsewhere. So have a plan, but that plan must be flexible and it must be open to change and making adjustments. It cannot afford to be rigid in the world in which we live. Everybody wants and demands data, particularly in the world in which we operate now, where there is such a heavy emphasis on actuarial analysis. One of the challenges is there's actually a relatively small data set in the construction and engineering market, which will help you to define accurate pricing. There are markets such as maybe Munich Re or Swiss Re that will have a lot of data, but obviously they are going to hold on to their intellectual property as much as they possibly can. EMEA is able to collate a lot of very valuable industry data, and that will help you to look at loss triangulations and pricing fluctuations over a period of time. But generally speaking, there is not enough data around to give you the granular information that perhaps we might ideally like, that might exist in the life insurance market or the motor market or property, for example. We can look at rating trends, but rating trends will only cover it on a portfolio basis. They're not going to be down to a granular level of occupancy, for example. And very often people track rating trends, but they ignore the importance of shifts in deductible and the way that deductibles are used as a cushion to manage attritional losses. And I think also it's hard to track sublimits and the impact that sublimits can have on loss quantum. So we need to get a balance right between underwriter judgment and data. And something else that I think is also very important is to monitor the losses that you missed. Very often our destiny is determined as much by the losses that we don't take on as much as the losses that we do take on. So look at the losses that you missed, and it could be by luck, it could be by judgment, because that will have an impact on your competitors, it will have an impact on your peer group. And I think that this is something that people don't pay enough attention to. We tend to track our own incurred losses, not the losses that we have very fortunately missed out on. So it's very simple to say, okay, you pull out of a weak market and you drive into a hard market, rotate in, rotate out, but it really is not that simple. There are costs of exiting and there are significant costs of re-entry. And I alluded earlier to the reputational risk of trying to drive your way back into a hardening market when you've been out for 3 or 4 years as terms and conditions have not been attractive. I think that the single most important tool in the armory of an underwriter is how you deploy your capacity or your line size. That's essentially at the end of the day, the raw material that we are trading, and it should be treasured and it should be looked after, and it should be only deployed with the full understanding of how it fits with your strategy and how it fits with the conditions that are operating in the market conditions at that particular moment in time. So it's about gentle acceleration, gentle braking and deceleration. And I think if you want an example of the reputational damage, I think one only has to look at what happened in Lloyd's in the second half of 2018 as a classic example of, in my view, an overreaction and indeed pulling out of a hardening market and missing out on the improving market conditions. The market is clearly driven by simple supply and demand. So in a weakening market, and this is easier said than done, I truly concede that, but one must try and focus on taking the heat out of the supply or oversupply dynamic. So in in weakening soft markets, we see people with a voracious appetite taking on more and more risks for less and less premium. And we don't have to be rocket scientists to work out that that business model is not going to go down terribly well in the longer term. So I think in a weakening market, we must manage expectations. Underwriters must sit down with their management teams and explain why it is that they're probably going to have to pull back their gross written premium expectations to adjust to those weakening market conditions. So you're going to get less rate, so you're going to get less income. You're going to be pulling away from business that is perhaps now no longer attractive, and you'll be walking away from business which is simply underpriced. And for your management teams to allow you to do that, or indeed to encourage you to do that. I think that whatever shrinkage is done in a measured fashion. If you pull out completely, you lose touch with the market. So I think that there is an expression which is maintaining a window in the market. In other words, you keep trading through that soft weakening market and you see what's going on around you. You see the activity of your peer group, you see the activity of your competitors, and that enables you to judge the pace of the market, and also, more importantly, to judge when things start to change and see those subtle shifts in the dynamics, and you can control the pace. In a softening market, there are probably 4 key factors that you'll start to see slipping away from you. The most obvious is clearly pricing, and you need to understand what your tolerance is for weakening prices and pricing adequacy. And you need to know where your limits are, and you need to be resilient and consistent in sticking to those and saying, below those thresholds, wherever they may be, you are quite willing to walk away and to lose that business or to step away from that business. Weakening deductibles will have an impact on attrition. And as we will see in a moment, attrition is probably going to be probably the key factor in your overall underwriting performance and how your loss burden is balanced. So weakening deductibles is something that we start seeing what deductibles eroded in a weakening market. It's a very early warning sign as to what's going on. We see coverage enhancements. So we see sublimits going up. We see coverage being broadened out. And we need to understand the impact that's going to have on loss quantum. And for those of us that have worked in the subscription markets, particularly in the London market, acquisition costs can be starting to be stretched, and when brokers start to offer you what I describe as a pay to play, that's probably, in my view, the sign that you've reached a fairly low point in the market, where brokers will literally start to charge you additional fees for accessing their portfolio. So we need to get the mix right. This is purely illustrative. This is looking at it from probably a very much a Lloyd's perspective, because there's obviously a degree of cat in this loss burden. I'm using 58% to net as a benchmark for the purposes of this illustration. So of that 58%, 30% from attrition, 13% from cat, 15% from large losses. So 50% of your loss, over 50% of your loss burden is coming from attrition. Now, if you're writing a portfolio in an area where there's no cat, or if you're writing 100% business such as plant and equipment, machinery breakdown, obviously your loss burden is probably going to be almost exclusively driven by attrition. And therefore the impact of deductibles is going to be the tool that you will probably focus on as much as price. It's relatively easy to rotate in and out of cat. That's a question of managing aggregate and managing line size. But I think it's important to understand where your pain is coming from. And I think that attrition is the gradual erosion of loss margins, underwriting profit. Large losses will have that shock factor, but at the moment we're going to look at the impact of shock losses. And what happens here is This is a purely illustrative, and this is certainly not to scale, as you can see. It is slightly US centric because we talk about Andrew, Northridge, World Trade Center, clearly, Katrina, Rita and Wilma, Sandy, Harvey, Irma, Maria. That's inevitable because the US market is clearly the largest market on the planet, and therefore when the American market sneezes, everybody else catches a cold. So I think that we cannot operate in glorious isolation. We need to understand that there are global events and global factors that will impact the market in which we operate. I think that here we look at some historic significant market losses. The London Underwriting Centre at Minster Court, 91. These losses are roughly between 100 and $350 million. These were all big events. These were events that at the time everybody talked about, who was on it, the impact was what the impact was going to be. What we see now is a magnitude of loss that we haven't seen before, and a greater frequency of these large losses in the band of 150, 200, 250 upwards. What I want to do is also illustrate, it's unlikely that there are people who will have been in the room in the first quarter of 1999, but the market conditions that we have now, and we have had since the second half of 2018, have a lot of similarities to what went on in Q1 of 1999, and I described it as too much pain. So it was just people were looking at their results going, this is just something that we cannot sustain. Things have got to change. Rates have got to go up, deductibles have got to go up, coverage has got to be cut back, acquisition costs have got to be cut back. It is simply unsustainable. One of the features of the 99 market was that there was a lot of retro activity. People were going out buying a lot of cheap primary reinsurance, and that market collapsed, and there was a lot of people left holding reinsurance losses that were not recoverable. I think the one thing I would like to say in the connection of World Trade Center was this is a good example of a global event, but which actually didn't have any massive impact in terms of direct losses into the construction engineering market, but it clearly had a correlating effect. The prices across the planet went up, including construction engineering on the back of World Trade Center. And I think that in 2018, we had the Itawango loss. For those of you that aren't familiar with it, this is a hydroelectric dam in Colombia, where they had some massive structural problems in the diversion tunnels. Tunnel collapsed, virtually having to rebuild the dam, huge DSU numbers, and I believe that the loss has been settled, but Itawango is by many margins the largest loss that this construction engineering market has suffered or experienced going back to year dot. So, you know, I believe Itawango is probably a billion plus. So many multiples of some of the bigger losses that we see down here on the left-hand side. So what are the features of these peaks and these troughs? I think that there are 5 key points that I want to focus on. Probably the decline is going to be faster than the rise. So the journey down is going to be faster than the journey up. Will you recover enough profit in those peak years to balance the losses in the troughs? And that's very important because the depth of the trough may be greater than the height of the peaks. And the trough may last longer than the peak. So if you look at it, you're probably going to have, over a 30-year period, you're going to have more soft market conditions than you are hard market conditions. It's not like you get 2 years good, 2 years bad, 2 years good, 2 years bad. It's not as simple as that. We can see soft markets that will last 7 or 8 years, then hard markets that only last maybe 3 or 4. So you've got to derive enough profit in those stronger years to enable you to trade through the weaker years. So use that as your contingency fund to get you through the tougher times. And the point that I make here is that the big difference is that there has been, in the last 5 to 10 years, a greater frequency of what we describe as mega losses, anything greater than, say, $500 million. And DSU, for those of you who are writing a CAR and EAR portfolio, DSU is a significant driver in that, because if you're going to get a big loss with DSU, the likelihood is that the DSU sum insured is going to get eroded, even if the physical damage loss is not as painful as it might have been. So we need to keep an eye on these key features. So we talked a little bit about Itawango. What it's done is it's created a lot of caution with regards to the appetite in the market for hydroelectric projects, and particularly for tunneling risks. And it's also, I think, people are asking more questions about their appetite to write DSU. I think that the other feature of this comment is that the way in which other markets will have an impact on what happens in construction and engineering. So shifts in property and energy. So we can see that, Deepwater Horizon, for example, had a big impact on the upstream energy market. It had an impact on the downstream energy market, and that can often trickle through into the construction engineering markets. I think I've pretty much covered the key points on this slide in terms of the correlating factors. I think this also, I think, reminds me how important it is to watch and to listen and to be aware of the market dynamics and what's going on around you, because construction and engineering really does not operate in a bubble. It does not operate in glorious isolation. And I think that sometimes there's a tendency that we can be a little isolated from the wider market dynamics and tracking what's going on in those other markets. So on a more positive note, how do we manage the upcycle? The important thing is when to make your move, is judging when the market is beginning to turn and feeling that shift, and that shift in the dynamic to a seller's market. And very often it may happen sooner than you think. And you have to make a reasonably positive move, because the probability is that the market, the firm market conditions, the hard market conditions, will exist for a shorter period of time than the soft market. So if you see the market beginning to move up and you think about it for 2 or 3 years, you may have missed the window, which is clearly not going to be, that's not going to be great. So watch what's going on around you, who's pulling out, and then begin to stress test the market conditions. And there are, again, a number of tools at your disposal. So you can seek out improved rates. If you're writing a CAR, EAR portfolio, hard to track rating trends. We can only do it on a relative basis and saying, well, what would we have got for that 12 months ago? What can we charge now? Nudge those rates up 5%, 7.5%. Stress test that. Stress test and look for higher deductibles, because you'll probably look back over a weak market of 5 or 6 years and C deductibles eroded probably much more than you ever realized. Stress test commissions. If your average commissions are 15, see if we can get away with 12.5. If your average commissions are 20, see if you can get away with 17.5. So just tweak those commissions, because it just goes straight down onto the bottom line. Sublimits will have been stretched and increased in a soft market. So tighten up on those sublimits. Tighten up on policy coverage. Classic example: soft market, brokers, clients demand leg 3 coverage on a CAR EAR portfolio. Tighten it back to leg 2. And more importantly, keep trading on your capacity and on your line size, which in a hardening market is going to be a more and more valuable commodity. So the messages here, I think, are: it's a crime to leave money on the table. In other words, if your benchmark pricing is coming out at, I'm going to say 3 per mil, and you say, okay, your technical price is 3 per mil, it could well be that in a hardening market, the market will stand 3.3 or 3.35 or 3.5 per mil. So don't leave money on the table, because that profit that you make on that rating improvement is going to go straight to your bottom line, and it's going to be what you need to get you through the next cycle. So be aware of how the market can stand and accept improvements in pricing. The raw material that we trade is our capacity. So whether you're in a 100% market or in a subscription market, your capacity, your line size is your raw material, and you must take control of that, take responsibility for that, and how you deploy that capacity and that line size is going to have a direct influence on your underwriting result. So if you step on the gas too much, it'll come through in your results. But if you miss the opportunity, again, your results relative to your peer group will also not look so good. Focusing on a subscription market for a moment, focus on your average line size and how you're deploying that line size in key segments. So where you've had underperforming elements of the portfolio, make those measured adjustments, and make adjustments in terms of industry group. So, for example, hydroelectric dams or pipelines or roads, whatever it is that's giving you the pain. See where you may have some regional variances. You may have experienced a lot of losses in Australia on floods, so make those adjustments there. And if you're in a 100% market, making sure you understand which clients, which segments are underperforming, and make those adjustments accordingly. So to summarize, shrink on the way down, but remain relevant. Easier said than done, but don't wait until you hit the bottom. Judging the pace of the opportunity on the way up, and using all of the tools at your disposal. It's not just about price. There's not enough data, particularly again on CAR and EAR, to determine really accurate pricing. So a pricing tool will be a useful tool to establish benchmark, and it will provide you with some consistency. Know where your baseline is. This will establish your tolerance, so that if your rates are consistently dipping below that tolerance level, that you start to think about shrinking your portfolio. So if you're trading in at maybe 10% below benchmark, that may not be disastrous. But if you're getting rates which are 15 to 20 to 30% below benchmark, that should be some warning signs that's going to have a direct impact on your net incurred loss ratio. And clearly, if the rates are, I'm going to say, below 30%, below your benchmark technical pricing, really that should set some alarms ringing. I think that this is something that people don't perhaps use as a tool often enough. The ability to just turn around and walk away and say, I'm very sorry, this is now, I can no longer accept this. And there are 4 or 5 reasons why you should walk away. Clearly, price is the one that we focus on more often, but the quality of the risk, the period of the risk. So you want to shrink your portfolio back to an average period of, say, 24 months rather than 36 months that you may have had before. What is unacceptable coverage? Do you want to continue to give leg 3 coverage? Do you want to continue to give guarantee maintenance coverage? Do you want to continue to give DSU coverage? Shrinking your acquisition costs down and making sure that those boundaries in each of these key areas are clearly communicated to your client or to your broker, so you manage expectations, and tell them what you're willing to do. In a subscription market, the brokers say, well, how much could you write? And I say, well, I could write 5%, but actually I'm only going to write 0.5 because one of these factors is impacting my ability to maximize my line size. So you've already made a meaningful statement by reducing your line size by a factor of from 5 to 0.5 and sticking with that, and not being, I'm going to say, talked back into something that you feel uncomfortable in doing. Right, I'm very conscious of the time, so I have just 2 more slides to wrap up on. So the obvious question, maybe not, where are we now? And I think the answer is, if you ask 10 people, you will get 10 different answers. I think that COVID has had an impact on the hard market. So if the hard market started in the second half of 2018, I think COVID has had the effect of pushing that market further on. There's no clear signs of any softening in the market right now. There's no obvious signs of significant blocks of new capacity coming into the market, which is going to impact rating levels. What would cause the market to weaken is some of the existing capacity providers start to get a little bit greedy, and they look at their results and they go, well, let's just step on the gas and increase our market share, take bigger lines, bigger shares, and that will obviously have an impact on the market terms and conditions. People in the various markets, not just construction engineering, tend to have rather short memories, and so we find people who repeat the felonies and the mistakes of 10 years ago, 15 years ago, and start to go down the same path. We may get some new capacity providers coming in, and I think that's potentially impacted by what's happening with interest rates. Clearly, we've had 10 years of pretty much 0 to low interest rates, so there's been no investment return. So people have had to focus on pure underwriting profit. Now, with interest rates beginning to squeeze up, and the probability is that that will be a continuing trend for the next couple of years, that increases the temptation to write for cash flow profit and compensating poorer underwriting results with improved investment returns. But no one's forcing you to chase the market down. So if the market does start to weaken, there's no obligation for you to chase it down to remain resilient. So just to wrap up, every cycle is different. You have to have some flexibility. You have to be able to be alert to those market changing dynamics and make adjustments on the hoof. So if you write a business plan now, make sure that it has the flexibility. You can make adjustments according to what you see in front of you. So play with your heads up. Being bold on the way up, but being bold on the way down. Don't follow the herd. Balancing data and judgment. And I think that whilst we must learn lessons from the past, I think it's important that we have an awareness of what's going on around us and trading according to those individual market conditions. And I'll leave you with one final thought. Everybody has a plan until they get punched on the nose, and Mike Tyson knows that better than anybody else. So with that, that's the end of my session. I hope that there is, I think I've probably overrun just a little bit, but I hope that there is a little bit of time that we have left, and we have enough bodies still on board that there will be some time for some questions and answers. So I'll hand over to Stephanie. Stephanie, are you there?
Yes, I am. Oh, it's echoing. Sorry, just tell me if it's bad sound. Marina, can you see the questions, or would you like me to read them?
Yes, I can see the question. We have, first of all, I would like to thank once again, David, for this excellent presentation. I think it's very up to date and very interesting. And we have two questions in the chat, very interesting questions from Isidro and from Pavel. I can read them. So the first question from Isidro is, he's thanking David for very interesting insights. And please, David, can you give the answers on the following questions? I personally have seen two major schools of underwriting, one mainly based on technical risk quality conditions, wording, and less in pricing. The other stating that this market behaves like a stock market, meaning based on statements like you cannot overperform the market and you have to base your portfolio mainly on rating. Would you please give your thoughts on these philosophies? And what is your expectation of rising interest rates on the cycle?
Okay, try and address those in order. I think you can outperform the market. I think that if you're able to balance your portfolio against your peer group, I think there are examples going back where people, either possibly by luck, possibly by judgment, it doesn't matter. There's a saying that we'd rather be good than we'd rather be lucky than be good. But I think that you can outperform the market. So you can balance your market on what you can pull out of a weak market earlier, and you can join a hard market and take advantage of that sooner than others. So I think that it is possible to outperform the market. With regards to the question about technical underwriting, and people who work in companies such as Munich Re or Swiss Re or SCOR will have a very different view of this than I, but I think that judgment is as important as technical perfection. I think that, for using an example, some of the pricing tools that are out there in the market, proprietary pricing tools, will give you a price for a poor quality risk. And in my view, there is no price for a poor quality risk. So if you've got a risk that you don't understand or a risk that is poor quality, you put your pen down and you politely decline to the client or to the broker, rather than be tempted to say, oh, well, you know, it's a challenging risk, so I'll put a high rate on it, thinking that that solves the problem. It doesn't. And I think that could be applied to certain risk occupancies, and I think that could be applied to CAT. With regard to interest rates, obviously, you know, interest rates are starting from a very low position, and they are nudging up by, you know, 25 basis points, maybe 50 basis points. So we haven't seen huge interest rate increases. But if interest rates get to 5, 6, 7%, then I think that people are going to look at their portfolio and going, right, if we can build up a volume of cash here, we're going to get a decent return on that in the markets, in the whether it be bonds or equities or wherever it is that they're going to, whether you're going to make your investments. So I think that there is a danger now that we get into a cycle of more focus on cash flow underwriting, relying upon composite profit, in other words, underwriting profit boosted by investment income. And I think that's a very dangerous position to get into. I think if you've got the ideal situation where you've got solid underwriting performance and the ability to get some investment income, then I think that's in good shape. But I believe that the key metric for underwriters should be pure underwriting profit rather than composite profit based upon investment income. I hope that answered the questions adequately. Silence is golden.
Still there, Marina?
Yeah. Thanks very much. We also have a question from Pavel. This question is about facultative market and treaty market. So there seems to be a disconnect in the steepness of cycles in FAC and treaty engineering markets. And in other words, magnitude and pace of changes, typically from soft to hard in treaty markets, looks to be well behind the facultative market. It's especially obvious in relation to local carriers treaties rather than international carriers or global treaties. Do you agree with this statement? And if so, why do you think it is the case? Are treaties really performing so much better than facultative, or maybe there is some another reason?
My background is the direct and facultative market. My only experience of the treaty market is being a buyer of treaty reinsurance. I think that there is a lag between the direct and facultative markets and the treaty market. And one of the things that has always slightly puzzled me about the treaty market is why some of the professional reinsurers have been so keen to extend significant treaty capacity to relatively inexperienced carriers and indeed relatively inexperienced underwriters in various regional contexts. And I think that is partly contributing in the past to soft market conditions. So, for example, we saw up until 2018, we saw a lot of capacity in Southeast Asia. We saw a lot of capacity in the Middle East. We saw a lot of capacity in Latin America that was driving very competitive terms and conditions in those regional markets. What's happened since is there's been a tightening up of treaty capacity, which has caused some of those regional players to have to put prices up, and so I think that there is some tightening in the engineering market, but not as much as we've seen in the direct and facultative markets. If you look at year-on-year rate rises in the direct and facultative market in CAR and EAR, which is where most of my activity is focused, you know, we can look back at rates prior to June, July of 2018, and we're getting, in some cases, 5 times more rate than we were then. You know, I think that the treaty market may well be lagging behind, but treaty provides very solid, reliable, predictable income. But it creates a lot of, I think, not unnecessary pressure, but I think it creates a lot of unwelcome pressure on occasions. I don't think I have anything more to add on that.
Thank you very much. And also we have a question from Arslan. How underwriters consider impact of emerging risk in managing engineering underwriting portfolio?
Sorry, could you repeat that?
How underwriters consider impact of emerging risks in managing engineering underwriting portfolio?
Emerging risks, I think the key thing is technology and keeping pace with technology. So, for example, if you look at certain key sectors like power generation, you've got constant improvements in or upgrades in gas turbine technology. In the petrochemical industry, you've got significant issues with regard to, for example, the use of catalysts. In certain, for example, the downstream energy market, you've got massive issues with regards to scale up. So the scale of projects is in some cases 2 and 3 times larger than it was 5 or 10 years ago. So I think that these are examples of where we have to keep tabs on emerging risks. New risks that, this is one that I saw only just about 3 or 4 weeks ago, is I was offered to participate on a Bitcoin mine. Now, as may be evident, I've been in the market quite a long time, and I may not be the most up to date on modern technology when it comes to cryptocurrencies and all that sort of stuff. And I literally said to the broker, I do not know what a Bitcoin mine is. I cannot visualize it. I cannot I cannot see what that risk would entail. He was able to enlighten me to some extent, but my view has always been, if you don't understand a risk, then don't participate in it. But that's an example of another emerging risk. What other emerging risks might we experience? I think a key thing that we have seen over recent years is a lot of stretching of supply lines and the supply chain. That's having an impact on policy periods, again, for particularly for CAR, EAR. But if you're writing machinery breakdown portfolio, for example, it'll have an impact on the availability of spares, access to replacement parts, and the lead time in getting parts reinstalled and getting the plant and facility up and running. And that's caused somewhat by COVID, somewhat by the events in Eastern Europe, and a lot of materials and equipment coming from the Chinese market and some of the challenges coming through from there. So I think that supply chain dynamics is something that we also need to be aware of. One last thing I think is the impact that inflation will have on loss costs. You know, we're now we've come out of a very low inflationary period for the last 10 years. You know, as inflation starts to creep up, the cost of materials, raw materials and equipment and labor will go up. That's going to cause inflationary factors on loss burden, which people are going to have to make adjustments to in terms of pricing or in terms of loss quantum. So those are some of the examples of what I would consider to be examples of emerging risks. I hope that was useful.
Thanks very much. We have another 2 comments on inflation from Marcus Wengers, but I think you had already touched this. What is your opinion regarding the increased inflation in certain markets? Will this have an impact on the current cycle as losses for older projects may go up? I think we have just discussed this. And also a question, are there any measures underwriters can take when writing risks today to mitigate the impact of inflation? For example, average close, final valuation, or indexing deductibles, or maybe something other? Or do you envisage this is a shorter term issue?
Well, I mean, clearly you can try and apply average clauses. I don't think the market conditions are hard enough right now that anybody is going to accept, or not anybody, but I don't think that average clauses are going to be easily digestible by the insureds and by the brokers. In certain niche markets, it is possible that you may be able to apply an average clause. I think that again, focusing on a CAR, EAR portfolio, inflation is going to have an impact on loss burden, and therefore the obvious thing is you just make sure that there are factors in your pricing that will enable you to generate more premium to offset against the increase in the loss burden. So, for example, you set the deposit premium based upon the estimated project value, but make sure you have an adjustment clause so that the premium is adjusted at the end of the project based upon the final contract value, including all of those inflationary factors. So you get more premium, albeit you get it at the end of the project. But hey, that's okay. That's still important to get that cash flow. And I think people now will start to become more focused on chasing for final contract value adjustments when they see the differential between the estimated contract value and the final contract value, and making sure that you get that extra premium back up based upon those adjustments. What other tools do we have? I think those are the key things that immediately spring to mind.
Thank you. And also another comment from Joe. His question is the following. With the impending recession in the United States, increasing interest rates and increased costs of borrowings, do you think this will slow down global economy and therefore construction project as their part? And as could this lead to too much capacity chasing after the premiums?
The answer is it could do. In actual fact, in times of recession, governments quite often have a strategy to, I'm going to say, build their way out of the recession. So if you look at what President Obama did after the financial crisis in 2008, he had a plan to invest trillions of dollars in US infrastructure, road, rail, bridges, all of that sort of thing, because for those of you who've traveled in the States, you know that the roads and the bridges and things are not in the best of conditions. So by putting that money into the economy, government funds into the economy, you keep the contractors busy. That means you keep the workforce busy, and you keep the supply chain moving. So it may have an impact on certain types of project. There may be, for example, fewer investments in hotels, leisure, all of that sort of thing, because if people have less money in their pocket, they're obviously going to be spending less money on traveling, going on holidays, and that sort of thing. I think one of the things that's going on at the moment is that obviously commodity prices are high. So there is going to be a lot of demand for power generation facilities. People are still building coal-fired facilities for reasons I don't quite understand, but they still seem to be going ahead with building coal. I think we're going to see more gas-fired power stations coming back into the market because to offset the shortages in supply. I think that other commodity prices, particularly gas and crude oil, is going to mean investments in refining capacity and refining and investments in LNG, both liquefaction and regas facilities. So I think that there could in fact be a slight uptick in the investment activity, causing more projects to come to the market. So I think that there'll be enough business around to keep food on everybody's plate. But of course, people get greedy and people decide they want to start to get more market share. It could well cause a softening in the market as people start to get a bit more voracious in their appetite for premium income and market share. But I'm a glass half full person when it comes to deal flow. Just one other thing on that is that there is actually a lot of capital around in the global markets. And that's not in the insurance market. That's in the global capital markets. And the banks and the funds that sit on that capital want to see that capital working. And one of the vehicles for getting a return on investment is project finance. So I think that there will still be an appetite for banks to lend to projects which are going to give a decent rate of return. So that is an important dynamic in terms of the viability of certain projects.
Thanks very much. I can't see any other questions. So maybe if there are any, please type them in the chat, or maybe you can ask them orally.
I have a question. I have a question. How many people do we have at the beginning and how many people do we have at the end?
My view, I think around 35 in the beginning, and now we have also 35. So
there we go.
Almost all are with us.
100% retention rate.
Wonderful. No, not quite. We're down about 1%, so almost there.
All right. Okay. I
well
can,
done, and
I can deal with that.
We had very interesting questions. Thanks, David.
Okay. Well, if there are any further questions, I'm sure that they can be fed through to Marina and Stephanie, and then forwarded on to me, and I will do my best to answer any other specific questions. Or if anybody wants to get hold of me, they can get hold of me at Rockstone, where you Google Rockstone and all the contact details are available on our website. So please feel free to get in touch if I can help people have questions that pop up afterwards.
Thank you very much again, David, for a very interesting presentation. And Stephanie, when will we upload the recording and the presentation on the site?
It'll be ready at close of business tomorrow, if not sooner.
Okay, thank you.
And when it's up, I'll put it on LinkedIn.
Okay,
good.
Wonderful.
Well, thanks to everybody for dialing in, and thanks to the IMEA team for setting this up, and I hope it was useful and beneficial for those that attended.
Yeah, thank you very much. Have a nice day.
Thank you very much. Bye-bye.
Bye-bye.
Bye, David. Thanks.